Steve, and then we'll get going. Okay. Thanks for tuning in for Investment Insights. Appreciate your time today. And Steve, you had a question? What were you going to ask the question was? Oh, he's already eating food. So that's good. So if you come in person, guys, you get to eat good food. So Steve asked a question. He asked the question is, what was the purpose of the Charles Schwab TD Ameritrade merger besides money? Well, if you guys are familiar with, in the past, most people that were brokers made money trading investments on charging you by the transaction when they did the trade. And so TD Ameritrade and Charles Schwab and a bunch of other brokerages, they eliminated the practice where they charged every time you bought or sold something, right? Well, when they eliminated that practice, when they were competing with one another, that was how they made money. So when they figured out they couldn't make money doing that, they started merging so there was less business in there. You know, I know it's weird, but if they still charged a $6 or $7 transaction fee to trade, you wouldn't have all these companies merging. You'd have multiple companies. But what did happen whenever Charles Schwab and TD merged is there was a process called remuneration. Remuneration was a process where, in order to be included on the transaction fee service, a mutual fund company or an ETF would pay a small fee back to the fund company to make that transaction free, because nothing is free. And so, so let's say you had a Vanguard fund. Vanguard was paying 0.06 or 0.07% to be included in that platform. Well, that's how TD Ameritrade and Schwab made their money. Now, Schwab made their money too because, and they actually got in trouble for this, they were keeping a lot of people's money in cash, not earning interest. And so that practice has since ended, but at the time, they were forcing in their platform you to keep 3% of your money in cash. Well, if 3% earn 10% a year, that's an extra 0.3% a year in fees that you're getting because they're making that money. You're not making that money. And so Schwab kept that going. TD didn't do that. And so when TD Ameritrade didn't do that, their stock went down because they ended the practice of remuneration. And so then their stock dropped. And so I believe that TD reached out to Charles Schwab and said, why don't we merge? Because they didn't have a CEO at the time. And that's pretty much why it began. And then, of course, this is now over too. And so Schwab has to make money in different ways. So how do banks make money? Well, kind of. So how a bank makes money is they want to get that money from you, right? So let's say you go to your bank and they want to pay you 3% on your CD, and they want to loan it out to somebody else for 7%. And they make the spread. I mean, so if you think about, our relationship with TD Ameritrade, Charles Schwab, is we don't work for them. We just hold our money there. So our job at our office is to watch them. Not necessarily, we don't work for them. Our job is to watch them for you. And so previously, when I worked with a different firm many years ago, I was an employee of that firm. So I'm supposed to watch you, and I'm also supposed to be an employee of the firm, which puts me in a situation of conflict, right? Because if I don't do what my employer tells me to do, which is mainly the company I work for, and they told me one time, you don't shut up, you're going to get fired, right? So multiple times, actually. And so, so those are the kind of things that you're looking at. So the nice thing about our relationship with McKay Wealth Advisory is if we don't like Charles Schwab and we say, hey, you guys aren't doing the right things, we can just ditch them. Now, you have to sign paperwork to move your money because your money's still held there. And that also provides you some safety. When Bernie Madoff stole everybody's money, he was holding everybody's money. So that allowed him to what? Write a check off of it. Right now, your money's held with TD Ameritrade. And so since it's held with TD Ameritrade, which Charles Schwab owns, I can't just access your account. There has to be paperwork. There's a process, right? I don't just do that. And so that creates a really neat relationship where you have everybody kind of watching each other. Now, you're watching Charles Schwab, I'm watching Charles Schwab, you're watching me, Charles Schwab is watching me. Everybody's kind of watching each other. And that keeps it kind of independent because, and realistically, since we're a fee-only practice, fee-only fiduciary, I can't get paid any other way. So years ago, I had my commission licenses. My commission licenses allowed me to get paid for buying or selling a product. I got rid of all those when we started this business. Now, most of the people that work in the industry are what's called duly registered. So they can take commissions or they can be fee-based, based on what they choose that day. Typically, a lot of times you'll see where they might pick what pays them the most money over being consistently one way or the other, in just my opinion. And so the nice thing is, Charles Schwab's deal with us is I can't even take a commission or a back-end payment if I wanted to because I got rid of all those licenses. So like let's say insurance. If you guys notice here, I've got my insurance license, but I can't sell most insurance. You know why? It's commission-based. So I can tell you all about long-term care. I can tell you all about the good things and the bad things about it. The difference is I can't get paid on it. Because every long-term care policy we've ever seen pays on a commission basis. So you don't even know what the person recommending the product gets paid. With us, everything's going to be transparent. And so that's really the big difference there. That's why they merged, Steve, several years ago. And we talked about this last time, in 2019, when everything basically started, right before COVID, this was going to happen a lot sooner. The Charles Schwab TD Ameritrade merger was going to happen basically a year or two ago, except when COVID happened, everybody just stopped, delayed, or really used it as an excuse. That's my opinion. Oh, we're not going to change anything. We'll just sit where we are, right? And, and of course, I love Charles Schwab, his name. Andrew Carnegie, he wasn't related to him, but Andrew Carnegie's main person when he started Carnegie Steel was a guy named Charles Schwab, not related. And so the cool story about that is that name is a really good name. It's been around a long time. But Charles Schwab, of course, started the company, I don't even know the year, 60s or 70s, for client service. And he's still alive today. He's one of the wealthiest guys in the country. But he was one of the innovators and pioneers to allow what we kind of do with fee-based business. He is the beginning. They're the ones that came up with it. So they're a very good company. But that is what is there. What other questions do you guys have about that?
You have two numbers up there, 3% the banks pay, and they loan it out for 7%.
Yeah.
You had said a few weeks ago, 5%, that it took 2% to keep the bank solvent.
Great question. So most banks try to operate on a 2% or higher gross margin. If you look at, I don't want to pick on any local banks in our area, but it costs a lot of money to pay all the staff in a bank, right? Just drive through Manchester, right? Do you see some pretty bank buildings? And here's the thing too. In my experience, the bigger, the nicer the building, the less money you make. And so if you guys go to a Citizens Federal Credit Union, there's a line to get in that place. And it's a pretty basic building for as much business as they have, right? I would argue that probably 80% of the people in this room do their banking with the Citizens Federal Credit Union. I know who we send most of our money to every day. Okay? And so now they're a different situation, but most banks try to work on a 2% or higher gross margin. So where the banks got downgraded, where you're seeing this story from last night, which is affecting the market today, is a lot of these banks loan money for commercial buildings. Now, if you guys are familiar with this term called remote work or hybrid work, we have a ton of people that are our customers that they don't go into an office anymore. Or if they do go into an office, they go in one day a week. My father, I was in St. Louis a week and a half ago for my birthday, and I was showing my kids where my dad used to work, these big high-rise buildings. And then you start thinking, well, my dad hasn't worked in one of those buildings in a decade. So all that commercial office space they used to pay for, They don't need it anymore. And if you guys look at the hiring trend, it's very easy to get workers if you work remote. It's not easy to get workers if they don't, because people are now expecting remote work. So a lot of your high-flying, high-paid employees expect to be able to work partially remote. Well, if you work remote, let's say 3 days a week, and somebody else works remote 2 days a week, you guys can share a building. You can share an office, right? And so then instead of having one office per person, you might have 5 people using that office, right? Or, conference room. Let's just have 3 people working in a conference room together. If you see at our office, we got this conference room here, and we have most of our team is working in the old conference room, because it's easier to collaborate together if you're all connected than if you're all spread out. So what that's doing is a lot of these banks loan money for these commercial buildings. And now, what are they worth? Because even the attorney, we recommend Jonathan Burns, who is coming in town in September. He doesn't even have an office. He works remote.
Who is this?
Jonathan Burns, the guy that you guys might have seen. And so he's got a big office in Nashville, but his firm was able to negotiate an advantageous lease because most of his lawyers are working from home. And if a lawyer can work from home, anybody can probably work from home. And so what you saw yesterday is if you look at like First Republic, that bank in California, they had a lot of loans with banks in San Francisco, on buildings in San Francisco. And so when people in San Francisco didn't come back to work, what are those loans worth? Not much. And so what you're seeing is, and even in Nashville, you're seeing a lot of that commercial office space that was going to be built not get finished. I mean, look at the biggest example. It was the Lifeway Tower. You guys remember the Lifeway Tower? They blew that thing up, and what's there right now? A hole. Because Amazon decided, well, we were going to build a big headquarters here, but we're not going to do that anymore. Because they realized that especially your high-performing staff can work from home. And so what this is doing is it's really changing, just kind of like malls. If you guys remember back 20 years ago, or not even 20 years ago, 15 years ago, we had an advisor here in town who put a bunch of people in some private mall real estate investments. Guess what that's worth today? 0. Because malls were the big thing. And now nobody wants to go to a mall. They're turning malls into warehouses, into shipping facilities. So you got a shipping facility with a marble floor. I mean, I don't know about you, but that's really kind of dumb, because if it's wet outside, you're going to be falling down. So that's what you're seeing. And so what we saw with the downgrade yesterday, which is not unexpected, is it said that, look, a lot of these banks are going to have to write off these loans. Well, look, if you loaned $100 million to somebody, and let's say that loan is worth, that building is now worth $50 million bucks, you got a pretty big loss with only a 2% margin. That's why, which I've got some history on compound interest to talk about today, but in the early Christian church, there was the Council of Nicaea. So if you guys study history, Nicaea was a pretty big Christian city in history. And so I didn't realize till yesterday that they ruled on interest. And the Council of Nicaea ruled, I think it was in, I'm going forward in my notes here. What year was it? It was, oh shucks. Oh man. Oh, 1325. They forbid clergy from charging more than 1% interest per month. Anything above 1% a month was usury. So when people complained about mortgages in 1325, they were charging 12% a year. It was the standard rate of interest. I don't know if that, it's interesting in the Bible, like there's 12 apostles, 12%. I don't know if that's part of it, but there's 12 months in the year. Anyway, there's a bunch of different things there that might be, if you dig into it, you might see that there was a reason for that history. But that was interesting, is that's what they used to charge. And so obviously that's what happened yesterday, is a lot of these banks don't have enough margin on these loans, and right now they might be getting paid, because a lot of those leases aren't running out yet. But as those leases run out, most leases are 5-year leases, and most loans are 20-year loans. So you guys see the mismatch here? You know, the only people that will typically loan you money for 30 years is the federal government, because it's stupid. Nobody should be loaning 30-year loans, my personal opinion. But that's what they do. And so that's, what you're talking about, Frank, there, that's really what they're looking at for banks market. Now, if you're a really good bank, you're trying to get more than 2%. And so what you're looking at is you've got 1% for overhead, 1% for profit. This is why banks have really performed very terribly as investments for the last, since the financial crisis. Banks have been very bad investments because your margins are so tight. And you know, we talked about this back in March. A lot of these regional banks that got downgraded, like Truist, is about to get downgraded in some of those banks. Have you ever been to Brave Stadium? That's who it's named after. A lot of those regional banks are really struggling because whenever they get in trouble, people move their money from the regional banks to the big ones because they're too big to fail. You know, and that's part of the problem with the Charles Schwab merger is now you have an $8 trillion company. The U.S. economy is over $20 trillion, so they can't let Charles Schwab fail. If Charles Schwab got in trouble, the federal government would have to spend money to save them. But they don't have to save Truist. They don't have to save People's Bank here in town. They don't have to save Capstar. And so what you're seeing is those stocks have crashed and the other stocks are still strong. Because, you know, hey, if you knew that your investment had an insurance policy, you're not that scared to invest in it. You know, but that removes competition, which is not good for the country. But it did, in this case, lower your fees. So that was good at the moment, but it still creates another challenge. Okay. Well, let me give you guys some key dates on the Schwab stuff so you guys have it. Okay, so obviously September 2nd will be the last day that you can trade with TD Ameritrade online. September 5th, everything's going to reopen as Charles Schwab. So don't freak out Labor Day weekend. If you don't see your account in TD Ameritrade, it's still there. The money just hasn't moved. So what they're going to do is your accounts are already open at Charles Schwab. If you don't have your account numbers yet, you should get them soon. I know we got ours. We get ours, Susie, Thursday or Friday. So you probably already got your account number if you haven't got it today. If you haven't gotten it, I will redirect you to Steve. He's a postmaster. He's with the post office. He can find your mail anywhere in the world. If you have any trouble, just go see Steve. He's for the people on the video, he's in Summitville area at the post office there. I think they open at noon today. So if you have any trouble with any mail around the world, he'll go get it for you. Break on stamps. You get a group discount. But anyway, that's, you should have your account numbers. Now, one thing you'll notice is your Schwab accounts do not have any money in it. Your TD Ameritrade accounts still do. One thing I said incorrectly in a couple of videos is they were going to add one digit to your account number. They actually have a whole new account number that's completely different than what you had before. September 5th will be when it opens up. You can open up your accounts today. You will see no money in it. Do not be alarmed. Let me say that again. There is no money yet at Charles Schwab. It's still sitting at TD Ameritrade. Do not be alarmed. Over Labor Day weekend, they'll move the money over. Now, going through these transitions before and seeing what happens, I would expect there to be, to go ahead, I would encourage you, go ahead and get your logins today if you log in your account. Get it done today, because when the other 300 people that aren't watching this video or watch the last 10 and don't listen to any things, don't even know we're changing, because I'm still getting phone calls like that, even though we've put out a lot of information about it and written multiple letters about it. When that happens, they're all going to try to log in at the same time. You know, there's actually a hack attack called denial of service attack, where what hackers do is they have so many computers trying to access a computer system that the firewall crashes and resets, and when it resets, they get in the system. So like, there is I think it's called denial of service attack. And so like, that's what, very possible to happen that first couple of days. Now, obviously, they've spent a lot of money. They spent a lot of time. They've been working on this for now 4 years. Hopefully, it'll be smooth, but always expect things to be delayed. Now, if you want help, our Black Diamond system is what we can reset here for you at our office. We can get you access on that, and everything should transition fine without any trouble on that. That's the big date on that one. We're not changing as your advisor. We've had that question a bunch. That's not changing at all. On September 5th, the first day of the transition, we're going to open from 8:15 to 12 p.m. with no appointments. So if you need help doing online access, you can do it then. Now, you guys are here today. Do it today, please, or soon. Obviously, you already talked about when they merged, the fees did go down. That's not changing. Some point in the future, there will be, I think Charles Schwab understands that they have to be competitive. So there's a lot of new companies that are coming in this space. The good news is once one company gets bigger, all these other people start saying, well, maybe I could do that. They start opening new companies, and so that is occurring. So someday in the future, we may have relationships with multiple companies, but right now that's where we are today. Yeah.
Question, Brent.
Yeah.
I don't know how many have transitioned to this Black Diamond, but I have it. It works fine.
Yeah.
What's the difference between the Black Diamond and the Schwab? Is there a difference?
Great question. So one of the he was asking the question of, is there a difference between Black Diamond and Charles Schwab? So that's a great question. They just drafted money out of the account yesterday, so there's a big difference between Black Diamond. They're definitely our most expensive vendor. So what Black Diamond does is they're the company that calculates your advisory fees, they calculate your performance, they also have a vault where you can store your documents if you want to save anything in there. And so what Black Diamond does is they do all that. Now the difference with Black Diamond is they are a third party. One of the things that, even though I trust myself greatly, and I love Hayden too, and he used to be an accountant, we don't want to be calculating our advisory fees like that because that's a pretty big conflict of interest. So we have them take care of it for us, right? And so what they do as a third party is since they're calculating your fees, they also calculate the value of your account every day, right? And so they have a login platform. They are 1 day behind. Because what happens with the TD site, which I love the TD site, it updates the value of your accounts about every second. You give it 5 seconds, it'll change, which is not helpful. I mean, I look at it all the time. You should not do it, but I do. It's not good for you to do that. That's why I have to work out all the time. But anyway, the Black Diamond's 1 day behind because they're going to take the value at the end of the day. They're going to say, what's it worth today? TD's going to report that information to Black Diamond, and so sometime late in the night it'll update. That's what they do. The nice thing about Black Diamond is you have an encrypted secure vault. So if you want to save copies of your will, if you want to save copies of your power of attorney, if you want to save a copy of your passport, you can put that on there. You can access it. We have actually a court case today involving a situation where a will somehow got missing and went gone. Make sure that doesn't happen to you. Maybe you have a family member that maybe not be the most astute.
They still going to be in play when they change over?
Oh yeah. They won't change at all. They are the largest RIA third-party reporting company in the United States. I don't know if there's any internationally, but they're probably the largest in the world. But they're really cool. They have a lot of cool tools. Most of our customers aren't using it. You do pay for it. So I would encourage you to use it. I know we pay them about $7,000 a month right now, so they're pretty expensive. They definitely get a lot of money. And so that's the, but they have a really cool system. They have the vault. They also, one of the things that we're hoping to do is get some of the videos on there. If you want to access the content, I would encourage you. We are in the process. Today, we had some trouble with our Facebook page, so we're trying to get more and more people switch to YouTube because Facebook continues to have a lot of struggles. And so, but we have to have, I think, 50 people liking our YouTube page before we can go live for live streaming. They have a different rule. But if you guys will like that and log in, that would help us. But Black Diamond is neat because, you can put videos right to you. But really just, the Schwab system is going to tell you what your account's worth. It's not going to really have you, the other thing about Black Diamond is your financial plan is also can be linked. We are linking those as well. And so basically you can see your performance. You can see any fees you've been charged. You can see what your account's worth. You can see your financial plan. You can save all your documents. It's basically one place where you can have everything in a secure location. And the cool part is if you get locked out, you can call 728-2130 and we can get you in. You're not calling somebody in the Philippines, give them your social security number, which is a true story. I've been calling Vanguard, and if you call them in the afternoon, they're routing them to the Philippines right now. So you're giving your social security number to somebody that's probably not making a lot of money, and your social security number could be worth more money. So those are things that I don't think is, I'm sure there's safety there too, but I'm just saying, I don't feel great about that. So, but that's, that won't change at all.
What's the difference between the Black Diamond listing and the TV listing?
Basically just,
Supposed to be the same?
no, and we've got another platform too, Larry, that I think you use called eMoney. We started that for a while, and we're still paying for it, but we don't use it. But the only difference is Black Diamond is a third party reporting, whereas TD is actually the company holding the money. So Black Diamond is reporting the date a day behind. They're actually doing your billing and your vault and all this
But they're
document.
never the same?
The values?
Yes,
Yeah, because they're 1 day late. So they're always 1 day behind.
mine's totally different.
Well, you're doing a different one. So you have a different system. We have a partnership with a company called eMoney as well, which is with Fidelity. Fidelity bought eMoney back several years ago. And so if you guys remember 2017, we were encouraging most of our customers to use eMoney Advisor, which also has McKay Wealth on it as well. And we still have that service as well. But that was going to provide a level of identity theft protection because you could link your checking account, your credit cards, and all that stuff right there. Well, whenever Equifax breach occurred, all of the financial websites in the world changed their security apparatus. And so now they were all requiring a 30, 45, or 60-day password change, and they weren't liking the fact that the IP addresses, so not to get too technical, but when you log in to your account online, you have what's called an IP address. That IP address says, hey, we are in, if Charter right now is using the local Manchester network, it's going to say that we're logging in from the IP address at 202 Woodbury Highway. That's a way to secure it. Because if it's logging in from Russia or North Korea, somebody's probably stealing your money. And so when they did that, because eMoney was basically using your password and your username to log in and create everything, the security doesn't like it. Because you're logging in, then somebody in Quebec's logging in. And so it's screwing up. So basically, it basically stopped working for identity theft. And then it was really unfortunate because before the Equifax breach, that system was very, very effective. And it is effective for what your situation that you're doing is, because you're looking at additional accounts outside of your standard money that you have. So we can link other, if you have grandkids or you have nieces and nephews that you're helping with money, you can actually link everything on that system pretty well. But the downside is the main reason why we paid for it is we were trying to get it to where you would have some form of identity theft protection, where you could tell if, hey, somebody just charged $1,000 on my credit card. When our Facebook account got hacked back 3 months ago, the first thing they did was they charged $900 to my American Express. Because that's what the whole point was. They were trying to steal the money. I would have paid them $900 to get it back. At the end of the day, that was what occurred. And so that was the whole idea there was you would have not just your plan, not just your vault, because it has a vault too, it has your plan too, but you'd also be able to link your credit cards and all your financial transactions at one place. And then, of course, when the Equifax breach occurred, all those banks, they just stopped working. And so that Fidelity actually bought eMoney with the idea that they were going to offer that to all their customers. And anyway, so that system is active. We have actually, I think we've got a couple people in the room that are using that system right now besides yourself, Larry, because it shows me the names. But that system still will work as well. But it's unfortunate, but no one's really found a great way to bring all your financial stuff together perfectly. Like I would like to have where I can log in one place and see all my checking accounts, see all my credit cards, see everything. That way I would know. And it also had three-factor security. So you had your cell phone code, your password, your username, and you had a PIN. So it didn't just have two-factor, it had three-factor, which is pretty cool because you're going to have to someone's going to have a keyboard logger and your cell phone to get in your system. So it made it really tough to do, which does happen though. It's still possible. Everything's hackable. That's a great question, Larry. So I don't talk about eMoney as much anymore. It was really nice whenever we got to roll it out. And for the first year, man, I loved that thing. We had almost everybody using it. And then Equifax decided, you know what they did for their password? They hacked them? It's called administrator. They didn't even have a random password. The password's administrator. So somebody just guessed it and stole everybody's credit number. Pretty crazy, And then, what the crazy part is? They actually made money off the deal because they started selling identity theft insurance. So they lost everything, and they didn't even get in trouble, and they ended up making the company more profitable because they started selling identity theft, which they caused, But anyway, it's my opinion. Well, they didn't cause it. They just lack of security contributed to it. So, any other questions about that with the Schwab stuff?
You have a link to Schwab on your
Website? We don't yet, but we'll get one up on that end.
TV goes away.
Yeah. And I'm pretty confident that whenever you try to log into TD, it's going to automatically push you to Schwab as well. I know we checked yesterday. We can still take checks written at TD Ameritrade 30 days after September 5th. But we're trying to get all of our recurring checks written to Charles Schwab because that way it won't be an issue, Any more questions about that? Okay, well, cool. I had thanks for the questions, guys. Obviously, I didn't do the disclaimer yet. Investment insights and educational space. We do our best to provide accurate information on financial, legal, and accounting advice. Please seek out competent legal, accounting, and financial advice to your unique situation before you make a decision. There you go. There's my little disclaimer. Okay. Anyway.
You're not speaking fast.
Yeah. I can speak a little faster, but I just had to give. Anyway, sorry. That's how I normally think. Okay, so a good little quote. I like this one. It's always summer somewhere, from Lily Pulitzer. Summer. You kind of feel. I'm a runner, so you feel the air kind of chilling off a little bit in the mornings. That's right before fall comes. You can kind of feel it's about to come. So,
You ought to use it's always 5 o'clock somewhere.
Yeah, well, that's good too. That's a different connotation, Frank. But financial peace isn't the acquisition of stuff. It's learning to live on less than you make so that you can give money back and have money to invest. You can't win till you do this. Dave Ramsey's so right, because you think about it, and I always preach this to our poor staff that works here is, it doesn't matter how much money you make. Making more money doesn't lead you to more success. It's if you're content with it or not. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Vegas. Paul Samuelson, I hate Vegas. I hate losing money, so I'm the worst. You can ask my wife back there. I'm the least enjoyable person to go to a casino with on the planet. I absolutely hate it. The most contrarian thing of all is not to oppose the crowd, but to think for yourself. Peter Thiel, and that really is true. So we already got the Schwab stuff. So a couple of things I had to talk about today were interest rates. do you guys feel like, do you guys understand the bank downgrade, kind of why that happened and what it is? Like, you understand that, you know, if you've got a loan for a $100 million building and it was 80% occupied before COVID and now it's 40% occupied, that means those people aren't paying rent. You guys understand why that? So there's something in American accounting, it's a principle that called mark-to-market accounting. And you can ask Hayden back there, he used to be a public accountant, is with mark-to-market accounting, if your asset's worth less money than it is on paper, you've got 1 year to report that. Okay? There was this company called Enron. You guys ever heard of them? A company called WorldCom. Okay, well, whenever the tech boom ended, those two companies had invested heavily in future, mainly internet infrastructure that nobody wanted after 9/11. Now, they want it today, right? So it's probably a pretty good investment. And if that company had been located in another country, it probably would still exist. Both those companies would. You know, but in America, with mark-to-market accounting, if you lose money on something, you got to tell your investors that you've lost money on it. You can't hide it. You can't just say, so I'll give you an example. So a lot of banks have what's called reserve capital ratios. Now what this means is they have so much money set aside in reserve in case they lose money on something. Okay? After 2008, the government decided that the best way to prevent another crisis was to raise how much money banks had to keep in reserve and make sure they only invested it into government debt. The best way to protect the banks from their problems is they got to give the money to the government. Right? Or they got to go buy mortgage bonds with it. And so we all know, and if you guys look at the charts there, which we haven't got a chance to get into yet, is if you look at what happened in 2020, is the Federal Reserve brought down long-term interest rates. And if you guys look at, which is good, it's for something else, because I'm going off the cuff. But if you look at the 30-year fix, which is the first one on here, that right there is 3%. That's how much you got paid to loan money for 30 years. You got paid what? Remember what we talked about with the Council of Nicaea? How much did the early Catholic Church say that you should do? 1% a month, 12% a year. Now we're talking about 3% a year. So we've gone all the way from usury. We're all the way into, too cheap. And then, as you saw, what did they have between the beginning of 22 last year and just June? Those rates had almost doubled, and then they did double by the end of the year. This is a 30-year mortgage bond we're looking at online, and so what happens is a lot of these banks, they took some of this reserve money. Let's say they took $100 million. And they put them in 3% bonds. Well, when the rates go to 7, that $100 million for 30 years is going to be trading at a discount, right? Because you're making 4% less money than for 30 years. So instead of being worth $100 million, let's just say they're worth about $60 million. They have what's called a $40 million loss. Now, is it recognized? They haven't sold it yet, right? So they're still getting paid their interest. But on paper, they have lost $40 million. And so what banks have to do is they will mark that bond for not being sold. They'll say, we're going to keep this thing to invest, and that raises their capital ratio. And it is a screwy government accounting thing, which I won't go into the details of it. They basically say, this bond will never be sold. This bond is now illiquid, but it raises the capital because we're going to hold this till this thing matures 30 years from now. Because the idea is you won't lose any money. You won't lose this $40 million as long as you hold it till it matures in 30 years. Of course, in 30 years, it's going to be worth less money because of inflation. Okay. And so The reason why a lot of these banks are in trouble is they put too much money in government bonds, which the government told them to do to prevent a crisis. Right? If you want to look at Truist's number one mistake is they have over 60% of their reserve capital in this type of stuff. They've lost half of the money on 60% of their capital. So now they haven't lost it because they haven't sold it, but if there's a run on the bank. So what happens there is you have this problem. Then the second problem comes up, involves commercial real estate. If you bought a bunch of office space, when you're building a building and you go past the second floor, it's hard to put much there but commercial space for like office space or condos, right? So I fully expect most of what you're going to see in Nashville is they're going to convert a lot of that office space to condos. And the thing about the Nashville market that makes it very strong is a lot of people go down there to party. So they'll be able to VRBO, or they'll have a lot of people that go there. But however, if you go to Cleveland, which we went to Cleveland on a weekend, see the Cardinals play, you want to talk about a dead city on a weekend? There's nothing there. All there is basically crime. There's nothing there. Because when Saturday and Sunday comes around, everybody lives in the suburbs, they go home. So Cleveland can't really convert their commercial office space to condos because nobody wants to live there downtown. Not picking on them. St. Louis is the same way. St. Louis, where we just were, if you go 2 blocks from the Cardinal Stadium, there are buildings, 20 times the size of this building selling for less money than this building. Because that's the disparity. Because nobody typically, unless they're going to a baseball game, if you're in the middle of winter, nobody wants to be in downtown St. Louis. It's cold, there's nothing to do, and there's no sports going on. Right? So that's the different market. And so if you had loaned money to purchase these buildings, you're in trouble. So you're going to have to write down. And so because of mark-to-market accounting, as these loans start coming due, the credit agencies are saying, hey, these banks have lost a lot of money on these things, and so we're going to lower their credit rating. When you lower your credit rating, it's kind of like lowering your credit score. If your credit score goes down, your interest rate goes up. So it becomes a problem because as you're getting in trouble, you have to pay more interest to get out of trouble. And so what happens is your profits end up going down, which is why if you look at the stock value today, those stocks are dropping because they're making less money. It makes perfect sense. However, it's unintended consequences. The government put regulation in place telling people to do this. They did it, and now they get punished. And by the way, Bank of America did it too. So did Charles Schwab. So did a lot of the big banks. The difference is they're too big to fail, right? So people are still invest there because they're going to be okay. Because if they need money, all they got to do is raise the rates a quarter point and money will flood in. Whereas if you're Truist, you're like, I'm not sure I'm going to give them extra money. Right? And that's where you lose the capitalistic argument because these banks have now kind of become the government in a lot of ways, which we benefit from it here at our office. That's how it is. So that's why they're in trouble. Okay, so we'll talk about the interest rates from here. It is interesting. The first recorded of someone charging interest is from 3000 BC in Samaria. Some of the documents indicate people were paying interest to lease animals or seeds for livestock. So interest has been around a long time. Albert Einstein believed the only miracle on earth was compound interest. I think his quote was, I'm probably misquoting, is those who understand it earn it, those who don't pay it. If you look at our country, that's very clear. So when we look at investments, we all know that stocks have done really well this year. Bonds has been really wild over the last 20 months. If you guys look at this chart here, the 30-year chart, right here, obviously, when you're looking at, this is the Federal Reserve from St. Louis. If you ever want some good financial statistics, as far as what I read, oddly enough, the St. Louis Federal Reserve has most of the really good financial data out there. This is the 30-year mortgage. You see we basically went from here to here. Now the good news is 30-year mortgage has been pretty stable. If you look at September of last year, you know, when we locked most of our bonds in, it's been pretty stable since then. If you look at the next one's the 10-year Treasury. Now, who gets Social Security here? So the one that you guys should really look at is this one right here, right? Because, you know, you guys remember that guy that ran for president named Al Gore? What do you always say you want to do with Social Security? Lockbox, right? You know? Well, all Social Security funds that are in excess of what they spend, they go into 10-year Treasuries. They go right here. This is what U.S. debt, majority of it's in. Okay? Now, what's interesting is, and then here, right here, one behind it is the 2-year curve. Now, this is even more crazy. This is what the Federal Reserve controls. This is where it went from 1% to 5% in 11 months. You know, if you want to know why there was so much volatility last year, that is a huge move. To go from 1% a year to 5% in an 11-month period, that's a pretty big move. And so that's created a lot of volatility in the bond market. And so but also if you notice there, if you break into it, the shorter term bonds, the 2-year bonds are paying more than the 10-year. Now what's weird about that? Why would you get paid less interest for longer term and more for shorter term? Anybody have any guesses?
Do you expect it to keep going up?
Well, opposite. So they expect rates to go down. So historically, if you have what's called an inverted yield curve. Historically, the yield curve used to look like this, right? Inverted looks like this. Okay? What that means is they think the Federal Reserve has raised rates and they're about to cut them. Because they're saying, right now the rates might be high, but they're saying in the future they're going to be going down. That's what an inverted yield curve says. Well, why would the Federal Reserve cut rates? What would they need to see happen to do that? What? Not just, well, maybe. But what would be the big one? That'd be a recession. You know, if you go into a recession, see, the Federal Reserve's job is to try to control the economy. They're trying to get the porridge just right. They're the ultimate microwave and demicrowave, whatever that be. Microwave and a freezer. They're trying to put just enough heat in there and just enough cool so we don't get, our porridge is just right. Which is very, very, very much an arrogant position, right? Because you don't really have that much control of the world. But that's what the Federal Reserve tries to do. You want to know why a lot of countries want to get off the dollar? Is they don't want their porridge controlled by the Federal Reserve. You know, good luck with getting off of it. But the inverted yield curve, what it indicates is the banks are saying right now, like I'll give you an example. So a local bank here in town offered a customer of ours 5.6% supposedly on a CD for 6 months to 12 months for the next 12 months because they're out of cash. But if you ask them to go 2 years, they won't even do 4.8%. Because what are they expecting to happen? Now you as an investor, if you're a CD investor, how should you approach that? Go long term. If the rates are going to go down if they're going to look, I mean, for the last 17 years that I've been an advisor, there's been about 2 years that you could get 5% on a fixed investment. Right? So if I'm retired and I can get a 4.8 or 5% for 10 years, I'm probably going to do it. Because I'm going to look at it and say the government owes $32 trillion in debt. The interest that they're paying, if all that debt gets refinanced, is going to be more than Social Security pays out a year, just in interest. So if you're running for office, and what do all politicians want to do? They want to promise you something. when I was president, the economy was better. When this, if I'm president, you're going to be richer. You're going to have what they used to do, 5 acres, a cow, a hog, I forget. I don't know. There's some kind of term. Yeah, 40 acres a mule. Yeah, all these different things. You're going to get it. Okay? So all the Federal Reserve has to do, which is appointed by politicians, is cut rates. They cut rates. The government now has more money, and then they can what? Spend it. So I'm going to bet, based on my study of history, that someone's going to run for office next year promising they're going to do something for you. Which is why it makes it really hard for me to find a politician I love, because I don't want them to do anything for me. I just want them to leave me alone. I want them to pay down the debt, not spend money. Reduce spending. Get inflation under control. Because if you don't spend money, inflation what? If they hadn't printed $10 trillion, you think you'd have inflation? You wouldn't have inflation. So what an inverted yield curve is telling us is the market thinks rates are going to drop. Now the big question is when? And I don't know the answer to that. The Federal Reserve guy came up right before you guys were walking in here. I was reading his story, and he was saying that he thinks they're not going to raise them anymore, but they're not going to cut them anytime soon. Now, what's been really amazing about our economy and our country is even when gas prices were over $5 a gallon, $6 a gallon for diesel, our economy still was growing. Now, part of that is because of when I remember I was in college, I was living in California, and I remember paying $3.50 a gallon for gas. That's been a long time ago. So one of the things with gasoline is gasoline really hasn't gone up that much relative to inflation. And also your fuel economy on your car has gone way up. So that does help substantially. But that being said, typically whenever gasoline was $5 a gallon and whenever interest rates were 7-8%, and we had massive inflation, typically we go into a recession. But so far we have not. I mean, everybody's been talking about recession. Now we're on our 20th month. And we have, I mean, if you want to, when I had my birthday, we went to the Arch, it was sold out. We went to the Budweiser Brewery. Even with all the scandals, sold out for 2 days. Okay, even Budweiser, right? They got all that scandal. They made both political groups mad. And their sales only dropped. Actually, they went up 6%, but their volume went down 1%. It made everybody mad, left and right, and people still bought their beer. But you don't have to drink beer. That's something you can cut out, right? You can't cut out food, but you can cut out beer. And so when you're looking at the curve, that's what they're saying. And so when we look at the bond market right now, you sit there and say, well, maybe they're going to be longer. But what the market's telling you with the inverted curve is either we're going to go into recession or the economy is going to slow down enough for the Fed now has to cut rates or just freeze them. And that's what that inverted yield curve is basically saying. And so when we look at this year, this is now the market's gone down a little bit since then, but through August 1st, bonds had only made 2% this year. Equities were up 21.2%. Now, one of the things also has been happening is small U.S. stocks are up about 10%. Now, why would small U.S. companies not do as well as big U.S. companies in this environment? Why this year is all the money going to large companies?
No one will lend them money.
That's, yeah. So think about this, right? That's a great answer, Chris. So if you're a pharmaceutical company, and let's say, Chris, you're a scientist, and you figured out a way to cure leukemia without radiation. Okay? But here's the problem, right? You need $100 million to get your stuff to market. And I'm an investor, and I can get 10% interest. Well, let's see, I can get 7% interest with no risk. Do I fund her $100 million? No. I just put my money in the bank, and I get 7% a year. Because most people that have money are over 55, right? Most people that have money, they're not looking for the big kill. They're just looking for what?
Sustain.
sustain my income, live how I want, have what I need. They're not looking for the big risk. Now, here's the thing. When interest rates are 2%, I'll fund your $100 million. Because guess what? I'm only making 2% of my money for 10 years. Now I can get 7% for 30. And so what happens is small U.S. companies are really, really rate sensitive. Because like a big company like Walmart, they have a higher credit rating than the U.S. federal government. Right? So if Walmart wants to borrow money, they can borrow it what? I mean, right now, I'm going to give you a choice. You can loan money to Truist, or you can loan money to Walmart. Who are you going to loan money to? Walmart. It's a better deal. It doesn't matter. If the economy's good, they'll sell you knickknacks. If the economy's bad, they'll sell you food. It does not matter. They are going to be fine, right? They're basically almost a recession-proof company. I say that, then something happens, but that's generally speaking how it works. And so small companies are still trailing the larger companies. And if you look at your portfolio, you'll see that. You'll see, well, I've made a lot of money in large U.S. companies this year. I've made a little bit, about 10% in small companies. I've not made a lot of money in bonds. So if you got a bond-heavy portfolio, they're still struggling. Now, if you play the numbers, you would say, well, we've already made 20% in the stock market. So what's likely to happen? Who's likely to carry the torch going forward? Probably going to be bonds. Because when those rates start going down, if you're locked in at 7% and the rates go back down to 5%, and you're locked in for 30 years, did you just make a heck of a lot of money? You did. That's my opinion. That's statistically how it normally works out. It doesn't mean it's going to this time. Now, obviously, the other chart you guys have here is the one on the bottom is this one right here. Now, it's a little bit difficult, but this one right here are two funds that are in a lot of our portfolios. One is the Vanguard Emerging Market ETF Index. This one right here includes, now, and this one here is Columbia Emerging Market EX China. What does the EX mean? No China. So this is emerging markets without China. This is the emerging markets with China. Now, if you notice last year, we sold most of our Chinese investments in January of last year. The reason why we did that is they were panic buying food and oil and natural gas, which means they knew Russia was going to invade Ukraine before anybody else did. Because they started doing it in August of 2021. Okay? Now here's the thing. As an investor, if you're a country that is threatening your two biggest customers, the European Union and the United States, how good is that for your business climate? Remember, the largest foreign investors in China right now are Taiwan, Japan, South Korea, and the United States. The largest consumers of products made in China is the European Union and then the United States. And right now, Russia and Europe are at war, right? And so China is trying to say they're supporting Russia, but they're not. They're buying all their stuff, but they're not giving them weapons yet. So think about the terrible position they are as an investor, right? Well, first off, their people make more money than people in Vietnam. They make more money than people in Malaysia. And they're in potentially a military conflict with their 4 biggest customers and investors. So it makes it hard to invest in that country, right? Because guess what happened? As soon as Russia invaded Ukraine, what did we do to them? No. We stole all their money. U.S. government is the biggest thief in the world in 2021. We stole $1.5 trillion from the Russians. If you go to England, they found all those rich Russian people's houses and soccer teams. They just kicked them out. It's our house now. They didn't go to court. They didn't even there wasn't even a court case. There wasn't even well, I get 6 months. No, it's hit the lawn. Get in your boat. I was in Africa and I saw them turn off their credit cards. No more Visa, no more MasterCard, no more American Express. Right? So the problem is, after we stole all their money, what did the Russians do to us? They stole all of our money. Right? Because we stole theirs first. So then everybody's like, well, they closed all the McDonald's. Well, they didn't start that. We started that. Right? So if China and Taiwan go to war over money, what's going to happen to any money you have in that country? We're going to take their money. Everybody's like, it's always funny. People are like, I don't want Chinese companies buying U.S. farmland. Well, I do. Buy it all. Because they won't go to war. If they invest here, they won't want to lose that money, right? Because the first thing that's going to happen is if China and Taiwan go to war, is what are we going to do with any, they own Smithville Farms, right? You think we're taking our pigs back? What do you guys think? Yeah, first thing we'll do, we'll take our pigs back. That's actually, there's a guy named General Marshall. He's a very underrated guy in World War II. And after World War II, World War I, we let the French and the British write the rules for Germany. In World War II, guess who wrote the rules? We did. And we got the Germans and the Japanese to invest so much money in America that we'll never go to war again. That's the whole concept. And so that's what this right here shows you on this investment is Vanguard Emerging Markets. If you have with China, the year-to-date return is 11%. Without China is 16.09%. That shows you how much the emerging markets outside of China are overperforming. Because basically a lot of those jobs are leaving that country and they're going to Vietnam, they're going to Poland, they're going to Malaysia, they're going to Indonesia, they're going to Mexico. And so as an investor, that's a big change here. So when you look at the trend line, that's what's happening this year. Is large U.S. companies are doing well, small stocks are still trailing, and bonds are still trailing. Now, oddly enough, if the Federal Reserve cuts rates or keeps them level, and we don't go into a recession, this next year when we talk, or maybe next week we talk, these two will be leading. Right? Because they're both connected. Because if rates go down, a lot of these drug companies start getting funded. A lot of these new ideas start getting funded. And then you also have the artificial intelligence, AI. Most of the companies that can afford to implement AI are big companies. They're big new ideas. And so they're getting a lot of investment attention because, if you guys have seen Chat GPT, as it's called, it's pretty neat because it's an incredible program where many of the customer service functions that people have had in the past, like when you talk to, you call Southwest Airlines and you're on hold for an hour, that software system is going to be able to fix that. So those jobs are going to go away. So they're going to save money. But those jobs are going to go away, so there's got to be new jobs created. And so that's kind of where we are for this year. I know I ran a little late on, we're late on 3, so we're okay, but close on time. Does anybody have any questions about this? And then I'll finish briefly with the other stuff.
I have a hypothetical.
Mm-hmm.
You show an increase in profit ratio and a decrease. If you could predict where that crossing is, would that affect what you invested in terms of interest rate?
Oh, sure. Yeah, if you could predict that, you wouldn't have to win the lottery.
Okay.
You'd make more money. It's always funny when...
They say AI can do that, but...
Well, yeah. Well, if it could, it already would have happened, right?
Yep.
So the thing about artificial intelligence is it's really not artificial intelligence. It's basically just a lot of different yes and no answers. So a software program, comes in and it basically says yes or no, right? And so what AI is these programmers have built a system which accounts for so many billions of different variables that it's, basically it's not thinking, it's programming. If it was thinking for itself, at this point, we probably would already be talking to it. Because it would already be able to get through the system. Because you can actually run data through electrical lines. So I mean, but if everything touched an electrical cord, if it was that smart, could eventually, at least, according to how things work, it could touch. So that's not what it does. But what AI does do is, if you say, well, my flight got canceled in St. Louis, how do you route that plane, or route yourself? If I'm in St. Louis, I'm trying to get back to Nashville. Well, maybe you fly to Dallas, Nashville. Maybe you fly to Atlanta, Nashville. It'll route it. So it's what AI is really neat about is it's all these scenarios. And so NVIDIA, the #1 large U.S. stock this year, I believe, is what they're doing is they're selling the microchips. They're selling the chips that can make it happen. And so the reason why it's such a powerful moment for them is they can actually, you could program your system with it, but they're expensive, right? And so they're like, so it costs a bunch of money, but it can power it. And I fully expect when we're talking with Charles Schwab in the future, a lot of those functions will be done by software systems, because they already are. It used to be you had a ticker tape, right? Since we've been talking here, the value of your investments has moved a lot. And just think about the ticker tape. It used to be what it was. And you had somebody running that. That's gone. So that'll keep happening. Yeah, dude.
We're $32 trillion bankrupt right now.
With that, yes.
So when the Fed raises an interest rate, obviously that affects the prime, the auto loans, the mortgage rates, and so forth and so forth. So when we're sitting out there spending $8 billion a day, probably borrowing about $6 billion from that, would we?
We're not. It's not that big of a change, but yes. It's like
Are we? It's not that big. In other words, an increase in the Fed, we're paying that. Are we buying 10-year bonds? Is that what we're doing? Basically, that's it, pretty much.
Yeah. So the federal government the Social Security funds will typically, the Social Security Medicare trust funds are invested in 10-year treasuries, and then the Federal Reserve sets the 2-year rate, the overnight rate. They don't set the 10-year rate; they set the short-term rate, right? And so then the Federal Reserve controls the printing of money.
So are you saying the debt that we have out there now, the $32 trillion, is that only 10 years back?
Most of it.
Really?
Well, it renews, right?
Well, okay, yeah.
Because you got to remember, unlike your mortgage, you're paying principal. Our government's just paying interest. So that debt might be occurred a long time ago. I mean, but I think Andrew Jackson was the only president to actually pay off the national debt, and then they all tried to kill him over it. Literally, the guy misfired twice with his gun. I think he was like 7 years old and beat him with a cane. So the thing is, some of the debt we have is from back then. It just keeps reoccurring. And so now the issue with, debt is, our country is definitely worth more than $32 trillion. So if you were to go out to somebody and say, hey, you make $200,000 a year, you want to borrow $150,000 in total debt, or $200,000 in debt, you would say you can pay that back. Like when I bought this building, it was $237,500. I had a signed lease for $2,100 a month, and I made about $50,000 a year. So they let me borrow the building, right? Because they thought I could pay it back. The reason why the debt was downgraded is they don't think that the Republicans and Democrats will work well enough together to handle the situation. And it really hits home in 2032, because what happens then? Social Security runs out of money. And so right now, the #1 expenses for the federal government is Social Security. So if politicians don't want to talk about it, but the only way to solve our debt issue is to reform Social Security and Medicare.
Or to get rid of your seniors.
That's true too. No, that's actually Neil. There's several there are several videos on that, Neil. But I'm not into that one. That would be really bad. So, but that is true. Because most of the money in our country, 80% of it is in people over age 55. So when it transfers from the next generation, there'll be a lot of taxes.
One last question. Do you think this new wealth
Thanks, Jerry.
tax bill by the progressives in Congress, is that constitutional? In other words, if I own $100 million, they're gonna go and tax me on unclaimed assets. Do you think that's constitutional?
So you have a constitutional for property taxes, right? So property taxes tax you based on what they assess your value of your building is. Because you don't, like this building right here, I didn't sell it, but I pay taxes on it every year for 12 years, right? And I pay, they assess the value at $360, which I'm very happy with that number. So, you know, hopefully no one's watching. But at the end of the day, so that would be the question with the wealth tax would be, yes, there's no federal rules, but there are some state laws around property tax that tax you, because I pay tax on this property no matter what. Now, I think that's a violation of the Constitution, personally, because I feel like when you look at, when they started taxing whiskey, you didn't have to buy whiskey. So they tax whiskey because, you know, if you don't drink, you don't pay taxes because you have to make the decision to buy something. So when they use some of my money for stuff I don't agree with, I agree. But there is basis in property taxes. So if I was a lawyer, I'm not, the way I would approach that would be is, well, we tax you on property. What's the difference? But most taxes are really related to when you buy or sell something, when you recognize you sell that stock, when you pull that money out of the IRA, when that's when there's an event. So most tax policy is based on that. So that would be interesting to see if that happens. There won't be a wealth tax in our country because all the wealthy people fund all the politicians. But but theoretically, you already have wealth tax. It's a property tax.
We'll end up like France, you know, when they did that, everybody realized that over there, everybody went across the border.
Well, they did income tax. They raised the income tax 70%. So the problem for me would be, how would the government, thanks Randy, how would the government assess it? How would they figure it out? You know, because what is this building worth? Is it worth, because I mean, no one sold it. No one sold or bought this building in 13 years. So what's it worth? I mean, you can tell me what you think it's worth, but until someone's got a check in their hands, and what it's worth today, or when I wait 6 months to find the right buyer, it's always funny when people look at the stock market like, oh, the stock market's down today. Yeah? Did you sell your house because it went down today? No, you have a number in your mind what you're going to sell your house for if you're going to sell it, and then you sell it. You know, if you had to sell your house today, you would not get the best price. That's why auctions typically don't bring the best price on a house, because they're like, well, A, there's a huge commission, and B, you're like, we've only got 20 people to buy this house in that room. Whereas that's why they're doing online auctions now, right? Because the big benefit of that is with an online auction is you're getting, hopefully, thousands of people looking at it. You know, and so that's the funny part. But there is some basis in property tax. So that would be the way. And it's always funny because people are like, well, this is a new thing. Well, wait a minute. They used to tax people based on how many rooms are in your house. Remember? That's why they didn't have closets. So, but that's the thing there. So that's the way that I would think they'd approach it. And the only reason why they're keeping track of what's in your IRA and what's in your investment accounts, what your house is worth, because they're starting to track all that data. They started tracking it 12 years ago. It's because they want to somehow tax it. Now, how are they going to do that? I don't know. Are they going to be? And by the way, by the time it goes through Congress and the Supreme Court votes on it, you're probably looking at 20 years from now. So you don't have anything to worry about in the near future. So thanks for tuning in on Facebook Live, and have a great day.
I got a